Today's market call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. With Fidelity Trader Plus, you can customize your preferred tools and charts and tap into crucial data across all your devices. So I can save an order on my desktop at home, get a mobile alert here at the studio, and complete the trade in the Fidelity app without starting over. Try it for yourself at fidelity.com/traderplus. 11 a.m. on this Monday, October 20th. Rainy days and Mondays always get me down, but they're both today, but I am not down because we have an exciting market. We have some exciting announcements, and I'm here with my main man, Dan Nathan. That's not what I usually say, but Dan says that.
I do say that. You are my main man, Guy. What is up today? You said, what is up? The market is just raging here and all good, bud. The S&P is up 14.5% on the year, and NASDAQ approaching 20% up on the year. We can do the math off those lows because at one point, the NASDAQ in April, what was it, down like 30%? Felt like a straight line. Didn't take that long to come back here. I just see a CSEA of green on my sheets here. What's going on here, guys? What happened?
And I think some of the consternation around the last couple of weeks, volatility index that had been trading higher. I think for whatever reason, the market seemed to be anticipating something over the weekend that didn't manifest itself. And then, have a continuation of this theme. VIX now below 19. Obviously, we saw it as high as 25 at one point last week. So it appears as though it's business as usual, and the market participants are sort of breathing this collective sigh of relief.
We've been tracking data about what this CapEx AI spend has meant for GDP, and it's obviously been a huge, huge offset of certain parts of the economy that have not been performing well. I look at my screens today, guys, especially as we get into the bulk of earnings over the next 2 weeks or so, and some of the biggest contributors to S&P 500 earnings growth, some of the biggest contributors to the gains in the S&P 500, obviously the NASDAQ, or all of these names, all these companies that are deploying, tens of billions of dollars, in some instances of cumulatively hundreds of billions of dollars. So that is making up all of this growth in GDP. It's worth noting that GDP is not expected to grow this year really over 2%, which is below the inflation data that we've had, right? Which has made this kind of rate cutting cycle a bit more curious than some might expect. And obviously at the end of this month, we're going to have a Fed meeting. The one thing I'll just mention today is I'm looking across my screens and I'm looking to see in a market where we have an S&P up 1%, a NASDAQ up 1.4%. Look at what's not performing well, guy. So NVIDIA is basically unchanged on the day. Oracle, which is the new, cloud darling because of all the contracts they've gotten from OpenAI and the like, is down 3.2%, down 7% on Friday. I'm looking at the neo clouds, which is CoreWeave and they're down 4% and 3% respectively. So it's interesting to me. Now, you could say, Dan, I see SanDisk up 7%. I see Micron up 3%. I see AMD up 3.5%. I mean, the list goes on and on of different parts of this infrastructure trade. But the last thing you want to do is see, let's say, NVIDIA roll. Microsoft's been underperforming. Oracle underperformed. So all of these kind of whatever you want to call them, hyperscalers, like you don't want to lose them because then at some point you have to put some more pieces together of this puzzle.
Yeah, I'm glad you brought that up. There are obviously things that are doing very well today. We'll quickly talk about the banks too, but what I'll say about Oracle, and this is something we talked about, Oracle is a name I think we collectively liked for a long period of time, but the move that we saw in September, early September, basically from about 230 or so in a straight line to 345 didn't make a whole lot of sense to I think either one of us. Now, stock sort of traded sideways there for a while, but here at 280 or so, is there a potential for us to retrace the entirety of that move? And more importantly, forgetting about Oracle specifically, does it mean anything necessarily to this broader trade? Because we've seen moves like that over the last year and a half before with some of these names that have had these parabolic moves to the upside. You've seen the back and fill. And then subsequently, these names have all sort of gotten back on their horse. We'll see if Oracle does the same thing or if there's something else going on moving forward.
Yeah, and the reason I highlight that is because we know that some of the earliest beneficiaries going back, let's say 2.5 years now, of this generative AI theme has been the major hyperscalers, obviously NVIDIA, who provides, all of the high-end GPUs, but then we've seen server makers and memory and storage and, all of them have kind of jumped into, the story here at some point, but NVIDIA has not confirmed any of the new highs,
Hmm.
in the last, week or two of the, the NASDAQ. And so I think that's worth noting. And then the underperformance, as we've been highlighting with Microsoft, Oracle of late. And you just don't want to see those stories kind of come undone a little bit. I want to make one point. I think Amanda has this. This is from Torsten Slok, Apollo, the Daily Spark. This was, I don't know if you saw this morning, Guy. It's one of the first things I read every day. Stock market performance since Liberation Day. And this is a really interesting chart. I think if you have this up here, Amanda. So it's talking about companies with negative earnings are outperforming companies
Hmm.
with positive earnings from early April. And to me, it's just another one of these examples. And you see that spread right there where investors are looking to reach more for risk, right? If you've basically moved on to, underproductive. When I say underproductive from a capital allocation standpoint, or unprofitable sort of names because you think you're full up in the other ones, you get to a point where how long can this last, Guy?
Yeah, well, this to me, so this is why I find this fascinating, is because in my mind, this speaks to sort of late cycle market stuff in terms of, and again, where we are in the calendar as well, people sort of reaching for performance or reaching for momentum, and that speaks to exactly what we're seeing. So these obviously are highly correlated for a period of time, and then they're starting to decouple, obviously in a meaningful way in the month of October, but it started in early September. So this can last. I mean, we've seen it before. I mean, this outperformance with companies that are basically have negative earnings can last. But I think the question you need to ask yourself is, what does it mean? Now, what is it trying to tell market participants? I would submit this is sort of late market cycle
Yeah.
stuff to me.
Yeah. And, I want to add something here. I know we're kind of putting together a bit of a mosaic because maybe this is not all the stuff that comes into your head as you're kind of trying to take stock of where the market is on this Monday morning here. But I want to pull up a tweet from Dan Niles, and Dan Niles of Niles Investment Management. And Guy, you and I have known Dan for
Hmm.
decades now. Rock star analyst at the end of the 90s into the early 2000s, became an investor at Neuberger Berman. Now he runs Niles Investment Management. And, he's been on the pod with us a bunch over the last few years or so. And he's probably one of the smartest sort of tech investors that you and I know. And, he's not one of those guys who just kind of digs in only on the fundamentals. He thinks about sentiment. Like these are like really important sort of things. And there's been so much talk of a bubble. So he's been saying this consistently, Guy, from the spring, that thinks there's going to be this massive run, okay, into the holiday season. And then at that point, he thinks you kind of want to take some, chips off the table a
Hmm.
little bit and think about what 2026, what's going to materialize here. And I just bring this up because he's highlighting the bear case. He's highlighting the things that Buffett's favorite valuation indicator. He's highlighting the fact that, it does feel irrational exuberance, but he can go back and talk about 96. That's when, Greenspan said that, and we kept on going. And then he can talk about how back then in the 90s, we were averaging 25% plus returns in the S&P 500 over those 5 years. You and I talked about this last week. GDP averaged 4.5%. Rates were higher. They were going higher. Now we're about to kind of lower interest rates. So lots of different cross currents here. And then he's talking about in 98, the NASDAQ went up 40%. In 99, it went up 85%. We don't have that sort of euphoria right now, Guy, but just like when you start reading this, is it that easy to time the market based on what is an emerging bubble and get the hell out before things get too, nasty on the other side of it?
We'll go back down. I mean, that's the market can stay irrational longer than you can stay solvent. I mean, that's something we talk about all the time. And if you look, I mean, that's the top of this post. And, all the things that Dan talks about here, I mean, these mirror some of the points that Paul Tudor Jones was making on CNBC a week and a half or so ago, talking about how, there's a concern around valuation, but he also sort of, I think he was making the correlation between what he's seeing now and what we saw in the fall of 1999. And he was quick to point out that, from the fall of 1999 into the spring of 2000, the market did extraordinarily well. And that was sort of the last gasp, but the last gasp can be exhilarating or whatever, the May West quote is at the top of that thing. So yeah, it makes sense. And that sort of dovetails with the Torsten Slok post that we put up earlier. All these things absolutely make sense. The only caveat I would make, and the only reservation I have, other than the obvious things, are I think things happen a lot faster in 2025 than they happened in 1999. So in 1999 October, it took 4 or 5, 6 months to have that move. I think things can be a lot more concentrated in the world that we find ourselves in today.
Yeah, and it kind of flies in the face also of what we were just talking about, unprofitable, companies outperforming, profitable ones. I mean, a big part of this move has been these massively profitable sorts of names. But, like there's just some weird action, guy. On a day like today, you see like Apple up 4.5%. You know what I mean? Like, and there's nothing really tied to the theme here other than it's a bit of a chase. So they're chasing unprofitable tech or unprofitable stocks, and this could be small caps, it could be mid caps, that sort of thing, unprofitable tech. But look at that. They're just like literally coming for one of the biggest names in the market because it has underperformed. Maybe it's a bit technical. Maybe it's like, this is one of the names that will basically be a beneficiary of AI when they finally get their act together in 2026. But how do you explain something like that?
Yeah, well, there was a report out, I think either over the weekend or early this morning. I lose track, but basically iPhone 17 sales in China were much better than expected. I think, they're up 14% or so year over year, or whatever the comparison they made. I shouldn't speak that quickly, but in a nutshell, there was very good news coming out of iPhone 17 sales in China. So whatever market participants, whatever machines or individuals are picking that up and run with it, as we're sitting right here, believe it or not, Apple very quietly is making a new all-time high and taking out the levels that we saw probably in December of last year. So, 8 or 9 months or so ago. Good for Apple. And it's had a really nice move off those April lows. But again, part of the problem, I think, is going to be just some of the valuation metrics around Apple. Now, Apple wins in a passive investing world. We've talked about it 100 different times, how they're in over 400 ETFs, of which they're one of the top 15 holdings. So, when money flows in, Apple will win to that. But, there's the other side of that coin as well. Then when, passive becomes active, Apple typically underperforms the broader market.
Yeah, no doubt. I just thought that was worth bringing up. And you look at that chart and you say, well, it's back at that all-time high, from late last year or so. And, you got to say to yourself, you better hope those iPhone numbers in China are good, because there's not much else going on as it relates to the AI story that is going to be a huge driver for those hardware sales at the moment.
No, let's take a look. Just before we, get into a trade that they're going to outline, let's take a look at what the week holds in terms of earnings, because it's sort of I don't want to say a hodgepodge, but there's a lot of things to look at here. There's something for everybody. Procter & Gamble at the end of the week, I think, is always, to me, a good watch, fascinating company. Bunch of other things. I think AT&T is its own story. I think IBM has become one of these stealth sort of quantum plays that not enough people are talking about. The one that I will look at, though, is Texas Instruments tomorrow, on top of everything else, because, Texan, again, very expensive stock, but, they find themselves sort of in the crosshairs of a lot of pretty good things right now.
Yeah, and I think part of it is that it's an industrial play, right? So if you think that the trade war is going to kind of find its way, at least, under wraps, or to the standpoint where people can model at least what, some of the issues are going to be for manufacturing here abroad, your ability to kind of have input costs. If you're a manufacturer, you're buying their chips, and this is, again, not AI related, then it might be really interesting to see what the company has to say about global growth and some of the end markets that they serve.
Yep.
The stock has clearly been a bit of underperformer relative to the broader, semi trade. The one to me on Tuesday is Netflix. And it's not because it's such an important sort of name as it relates to the broader tech. I mean, I think you and I would both put this into, more of a media bucket. We're not going to suggest that, generative AI is that important. This is a company from a machine learning standpoint. I mean, they would tell you that they've been using this sort of technology for, a recommendation engine and the like here, and some other technologies there for a long time. If they started to tell us that generative AI was helping them from a content production standpoint, from different processes, whether it be marketing and stuff. Great. I'm not sure the stock is going to trade off that right now, but you see that this is not confirmed. The new highs in the S&P going back until
Mm-hmm.
late June. And so I don't know, man. This is an interesting one. Why this is interesting to me, I want to see how investors react if the quarter's good and the guidance is good and the commentary is good.
Yeah, and obviously Netflix is one we talk about at length. And what was something about last quarter stuck out to me. We had Tom Rogers on Fast Money, and Tom, I think, as a lot of people know, has been a steadfast Netflix bull for many, many years, at least 5, if not longer. And he's been right to be that. Something though concerned him with the last quarter, and he was quick to point out that something seemed to change a little bit, and he was not as bullish as he has previously had been, which was a sea change. Now, I don't think he thinks the story is broken by any stretch, but he thought the stock could take a bit of a breather. And Dan, that's exactly what it's done since they reported their earnings, last quarter. It's been sideways to lower ever since on a market that obviously has done extraordinarily well. So on that alone, I think Netflix is really fascinating to watch.
Yeah, and again, this is one of the ones you don't have to play every name into, if you're a trader, into earnings. Sometimes it's more interesting to hear what these companies have to say and what the market reaction is to it. It may give you an opportunity after the fact. Listen, we're going to hit a lot of these names later on in the week in the market call. I just think we wanted to kind of flash them up here a little bit just to see what we're looking at over the next couple of days.
100%. And I mentioned at the top that we're excited. And I know I can speak for you with this. I can speak for everybody at Risk Reversal. We're thrilled that Fidelity is back. And obviously, you talk about gold standard in the industry. Well, I think Fidelity is there. So, when I'm trading, I want real-time data. I want customized alerts. I want powerful tools that can help me act quickly. But most importantly, I need an easy way to access those insights wherever I am. And it's Fidelity Trader Plus platform. You can stay closer to the trade with seamless access to your preferred tools and charts across desktop, web, and mobile. When timing is everything, Dan, you need a platform that can meet you where you are. And Fidelity Trader Plus is exactly that.
Look, guy, you're all over the place, by the way. So, you got to keep in touch.
I'm never in one place, never in one place too long. Got to move.
You are also right. I've had the pleasure of working with them going back to late 2019, and some of the products that they have really been working on since then. I know that they just relaunched this product, the Active Trader Plus, and it's a great product. So we're really excited to be working with them. And so thank you. Thanks for being back here. Guy, we talked about some names. Well, let's do banks, and then I want to go to pharma, because you and I think we have an interesting setup in pharma that we want to detail. But last week, I think really the dialogue or the narrative in the markets was this week and a half of bank earnings, large, money centers. And then we had a bunch of the investment banks. And I think for the most part, things look really good. I don't think there was anything to shake a stick at. I think people are excited about just net interest margins. They're excited about IPO calendar and M&A and trading, and everything looked great for the most part, right? The bugaboo last week was regional banks and some of the loans that they have out and some of the losses that some of these guys have taken. But it is worth noting that we're seeing the big money centers just kind of raging. Even like a Wells Fargo, are they making new all-time highs? I know they had that big day here. So it's through it's right back there. Even like a JP Morgan, which pulled back a little bit, it's kind of firmed up. It really felt like, it's just like taking a little off the top. If you're into that, Jamie Dimon said, he's not buying the stock, but again, that stock is kind of firmed up. But really is the regionals that you probably want to focus on.
100%. And, we're going to take a look at a KRE chart. And I think if my eye works the way I think it usually works, I'm seeing a bit of a head and shoulders. And, if you mention the KRE, and again, I want to be quick to point out, I'm not suggesting that these are the best constructed ETFs of all time, but this is one that people look at for the regional banks. The KRE, Dan, as you probably know, made an all-time high in January, I think, of 2022-ish. And that is obviously approaching 3.5, 4 years ago. So with that in mind, you look at the first side of the shoulder was made probably in the spring of 2018. I just mentioned the all-time high. And then you have this other shoulder that we're looking at, and the underperformance for a lot of reasons. The one thing that you would think, and this is just me, given the strength of the banks, the big banks, and given a lot of the M&A activity that people are talking about, the lack of regulation or deregulation, the potential for M&A, if you had told me all those things, that backdrop, and the market's an all-time high, you would have thought, at least I would have thought, that the KRE would be completely outperforming its bigger bank rivals, but it's obviously not. And I think that there's something concerning about that. Quickly, in terms of the big banks that you just mentioned, I think you have a couple things going on. Jamie Dimon basically told you his stock is too expensive. He said that at $300 and something at 3 times price to tangible book. By the way, he also said that when the stock was trading about $210 a year or so ago. So both things can be true. I think he felt it was expensive then. It's expensive now, but the stock has actually had a huge move over that period of time. So there's that. Wells Fargo, to me, is just basically them getting out of the penalty box. And that, by the way, mostly self-inflicted wounds there. So to a certain extent, that makes sense. And a name like Citibank, if you want to sort of, look at that triumvirate, that's a company that I think is basically getting re-rated, and a company that's a bit of a turnaround story under Jane Fraser. So those 3 names, I think, have all their own very unique stories.
No doubt. Let's move away.
Broke that down pretty well, man.
You
Jeez.
nailed it. I don't even need to add anything to that. But you and I were looking at the pharma space. I think that, like, despite, I guess, some of the kind of the stuff that we heard out of the White House over the last week and a half about GLP-1, so these obesity drugs and kind of the pricing stuff, I know that Eli Lilly and Novo Nordisk, investors did not like to hear that. You can talk about, well, maybe that helps to kind of grow the addressable market, but you know what I mean? Like in the near term, that is not going to be great for margins. And let's take a look at Novo, because this is one, you don't like to give yourself pats on the back ever.
No,
but
it hurts to do that. My age.
Your your shoulder and everything like that gets back there. It's kind of hard. Novo, when it had that gap lower, okay, this was in the summer from $70. Maybe let's throw the chart up here first for a second here. This is one where you thought this is an accumulation sort of story here. It was kind of baby with the bathwater. That was a massive gap. Okay. So let's go back to the other slide for a second. What have we been talking about here? So it's Eli Lilly, it was Novo Nordisk. It was a 2-horse race, right? And both of these companies were really geeked up, or at least investors were, about the ability for these drugs to be approved for other comorbidities, right? So not just obesity. And that was a big part of the trade, I think, in 2024. But at some point, Eli's data kept on getting better for their existing drugs, kept on getting better for some of the other ways that they were going to kind of, expand, some of the options, whether it was oral and the like here. So, this Novo thing, set up kind of interesting for a bounce. You kind of nailed that, right? But let's look at some of the other inputs that I just think are interesting, because, I was looking through some charts this morning. Oftentimes I'll start by just kind of scrolling through, see what's acting well relative to itself, its peers, other groups, and then obviously the market. And Novo really stuck out to me as one guy that looks very, very vulnerable. And so on a relative valuation basis, we can talk about that in a second, but look at this thing. You see this downtrend. It's a very orderly, series of lower highs. And you can say to the penny, right? And then you could say, well, look at that uptrend, that if you were trading and you caught that, that's great, right? But then on Friday, on Friday, you had that gap below that uptrend. If you just look at how this stock is traded, you've had, a gap, consolidation, gap lower, move lower, a little bit of a rally, consolidation, gap lower. So we're seeing that again. So what do you do technically with something like this? Because to me, it looks like a train wreck, and it really looks like it's probably heading back to those August lows, guys.
That's what it feels like. And just for full disclosure, I mean, this is a name that I try to be bullish on a number of different times on the way down. Finally, in August-ish, it finally made a tradable low, and it bounced, but not nearly to the extent that I thought it would. It had a decent bounce, but, again, I think your points are well taken. The bounces have been feeble, and with each time, the bounces get less and less robust, to use a certain word. And if you look at the potential for it to go, especially with that news out of the White House, I think it was on Thursday, that, they're going to start to look at GLP-1s and the cost associated with it. And that's the reason that Eli Lilly traded as poorly as it did at the end of the week. So where can this go? Well, as you mentioned, the August low, I think, was somewhere between 45 and 48-ish, depending on the day you want to look at, which sort of mirrors the low that we saw in the fall of 2022, when all of a sudden all these, the GLP-1 names started to get on the move in a meaningful way. So I do think, a potential move down somewhere between 45 and 48, given just the lack of performance now going on the better part of 2 years
Yep.
is something to sort of take into consideration.
Well, let's do that. Let's look at the 5-year really quickly because, that 45 level, what you're saying is the low from that kind of August period. I mean, guy, just look at how this thing, when it gaps, it goes through those prior lows, right? And so, you tell me where the low is. Now, there's a couple things I want to focus on. So let's look at Novo versus Lilly, which you just highlighted. So you've seen this sort of break in performance of late, and you can see it's been happening actually for the last year and a half or so. But we do have a 1-year chart of the two of them versus each other. Okay, you see that right there. Here's the thing, guy. The week of November 3rd, on the 5th, the company reports earnings, but they're also presenting data for their oral drug of the semaglutide, which is their version of the obesity drug, Wegovy. It's a low dose, it's oral pill, and it'll be interesting to see how that tracks here. So a lot of things going on that week, especially with earnings. I just want to go quickly to the implied volatility. Look at how the price of options in the blue line, guy, have just shot up. Okay. A lot of it had to do with that gap. I think there was probably some protection buying once you saw those headlines out of the White House. And then you see historical in the yellow. So big spread there. What does that tell me? Option prices are expensive. Last thing I'll just say, the implied movement in the options market between now and November 7th, that's the Friday weekly expiration, it's about 12% in either direction. And so that's including earnings, and it's including that data. So let's keep an eye on this. This one stuck out to me, and I know this is one that you've been focused on also.
Yeah, I think that this is the chart that you want to look at. You're getting basically, you look at a couple times in history, you've seen, excuse me, spikes in the implied vol, and you're seeing it now. So as a trader, you want to take advantage of these things. And, you can make directional plays. You could just be making a vol play. But against what Dan just talked about, those catalysts coming up over the next 2.5 or 3 weeks, this is really a fascinating look.
Yeah, and just lastly on this, we'll take a look as we get closer to when you have the price of options this elevated relative to the historical. It makes sense to sell more options than buy if you're looking to do something from a directional standpoint that could find itself in the way of a butterfly. We'll talk through that strategy as we get closer to the data. What else you want to hit, guy? Because you could throw a dart here and you could find a stock or a group that are performing very well, other than what we just talked about and some of the names as it relates to.
Yeah, listen, individual names we talked about. I think, again, banks are going to be worth watching. I do think healthcare, obviously, the semi trade and the AI trade, and now again, everybody talking about quantum computing. The market seems again October 20th. You go back to what Dan Ives said, and you go back to Paul Tudor Jones. I mean, are we in sort of the throes of this final euphoristic move to the upside that we have seen historically? And the more important question is, if we are, how long will it last? But the one thing I will continue to watch is the volatility index, which showed you something last week when it traded up to 25 on not really horrible downside days. There was clearly something going on there. And I think volatility to me is still going to be a story as we get towards year end.
Well, one thing, going back to the Dan Ives thing, and he's talking tech for the most part, but there's 3 things right here. And if they all go in the right way, and let's say the right way is the good way, right? So let's just say the shutdown and the trade stuff will get resolved, right? Like, we can agree on that, right? And at that point, might you see some sort of relief? And I don't mean like the stock market takes off another 5%, but might it set the stage for a few weeks? We get through earnings season and there's no hiccups there. So all of a sudden, everything's coming up roses. You know what I mean? And all of a sudden, we look at the S&P in 23, it was up 25%. In 24, it was up 25%. This year, let's say we're up 14.5% right now. Maybe we run. Maybe we're up 25% this year. I'm not saying this has to line up the same way as it did from 95 to 99, but everyone's trying to figure out where we are in this kind of similar sort of tech bubble. And again, we'll say a tech bubble, not a bad thing until it bursts, right? Because you make a lot of money. That's what Dan Niles is talking about. But we might be in a situation where the Fed is cutting into all of this great sentiment, all of this news that might be settled in a nice manner, you know what I mean? Setting the stage for a market that continue to go higher. That's the bull case right there.
That is a bull case. And again, that's the point that more than a few people have been trying to make over the last few weeks. And that seems to be right now a likely outcome. Again, what I'll be quick to point out is I think there'll be a lot of people that want to make the correlation in terms of duration between what we're hoping to see now and what we saw, 25 or so years ago. And the only point that I would make, you could see the same type of performance potentially, but I think it could take place in a much shorter period of time.
Yeah, well, we will see. And just the other one, just the wrapper on all this is like when you have earnings, you have guidance, you get to read management's, like their kind of tone and stuff like that. Sometimes that actually could take precedence over all of those other issues because the market is within 0.5%, the S&P, or 1% of its all-time highs, given everything we know that is not resolved. So who knows? All right, Guy Adami, we covered a lot of ground here, man.
We did. And again, we are thrilled to have Fidelity back. So, thank you for your trust in us. We're looking forward to this continued partnership. And we obviously love it when the folks join us. We'll be back tomorrow. We got a big week. We just had a great podcast, by the way, with Danny Moses, Vincent Daniel, Porter Collins, and you and me that dropped on Friday. You should check that out. A lot of people have reached out. They said they really enjoyed that.
By the way, two-parter. So the Friday one was epic. We had a lot of great conversations about a lot of stuff that, we got their perspectives on a lot of things that we were just talking about. But then we had the second part, Guy, drop in the Risk Reversal podcast feed this morning. So go check that out. We appreciate you being here. We'll be back tomorrow at 11 a.m. Check out the Risk Reversal podcast. Thanks to Fidelity. We'll see y'all tomorrow.
This episode of Market Call is presented by Fidelity Investments and their all-new advanced trading platform, Fidelity Trader Plus. Try it at fidelity.com/Trader Plus. Fidelity Investments and Market Call are not affiliated. Views, opinions, products, services, and strategies discussed are not endorsed or promoted by Fidelity Investments. Fidelity Brokerage Services, LLC, member NYSE, SIPC.